Welcome to my channel. Today we will be talking about the best loan structure for Amazon sellers. Term loan versus merchant cash advance. I've been in the trenches as an Amazon seller, and I've had to choose between these two funding options. Trust me, the right choice can seriously impact your business growth, while the wrong one can choke your cash flow. Let me break down my experience with each structure. The term loan. Predictability is king. A term loan is your traditional bank-style funding. You get a lump sum up front, and you pay it back with fixed, scheduled payments, usually monthly, over a set period like 6 months or 2 years. The biggest pro for me was predictability. I knew exactly what my monthly payment was, which made inventory planning and budgeting simple. I could lock in my cost of capital with a fixed interest rate and build it into my P&L with confidence. This structure is ideal if your Amazon sales are stable and consistent year-round, and you have a clear, long-term use for capital, like a big, one-time inventory purchase or major brand investment. The downside? The payments are fixed, which means if you hit a slow sales month, that set payment can strain your cash flow. Also, the application process is often more rigorous, requiring better credit and a longer business history. The merchant cash advance, MCA flexibility at a price. A merchant cash advance, or MCA, is different. It's not technically a loan. It's an advance on your future sales. You get a lump sum, and you repay it by giving the lender an agreed-upon percentage of your daily or weekly Amazon sales. The major benefit here is flexibility. If my sales were crushing it during Q4, I'd pay back more quickly. If January was slow, the repayment amount automatically dropped, reducing the pressure on my cash flow. This is fantastic if your sales are highly seasonal or unpredictable, or if you need quick, short-term working capital without the hassle of a lengthy approval process. But here's my warning. MCAs are expensive. They use a factor rate, not a simple interest rate. And when you calculate the true annual percentage rate, it can be significantly higher than a term loan. The cost of convenience and flexibility is high. And if your sales drag out the repayment period, the effective cost increases. I found that I was essentially giving up a bigger slice of my revenue for a longer time. My conclusion for Amazon sellers. So, which is the best? It comes down to your business stability. If your Amazon business is established, has predictable, steady sales, and you want the lowest overall cost of capital, then the term loan is a superior structure. It's better for long-term, strategic growth. If your business is new, highly seasonal, or you need fast cash immediately and are willing to pay a premium for flexible repayments, then the merchant cash advance can be a useful tool, but treat it like an expensive short-term fix, not a long-term strategy. Always calculate the total cost of capital before you sign anything. With that being said, thank you for watching. For more finance videos, kindly check my page. Please like, share, comment, and subscribe to my channel. Thank you.